Good morning. We are starting our class from where we had left in the previous session. Now we are here on discussing forecasting income. What is a forecast? A forecast is just a statement about the how the future will turn out based on evidence and assumptions. In business, project forecasts often involve the analysis of data such as the performance history of a particular project. And the purpose of the forecasting is to give the manager's insight into how profitable figures are likely to be in the future. Now, say if you are investing in a project and if you are doing some kind of work or some kind of a job, of a new project job, etc., then you would like to know how much profit could you possibly incur. Now, this is known as forecasting of a statement. And this does not only include forecasting of a statement, it might also include forecasting of, say, working capital. How much is the working capital requirement? Because first of all, before investing, the main job is to know how much you are investing, and how many terms or how many times you will have to will you require to make the investment. This specifically turns out in the case of working capital or operating income. Now, the project focus often involve the analysis of data such as the performance history of a particular product. Say a particular product such as, say, a particular brand of a mobile phone, and the evidence turns out that this particular brand of the mobile phone has a good history. Particular brand, say Samsung, Galaxy mobile phones has got a good history. Now, if the Samsung is introducing Model 10, Model 11 on the same Galaxy series, it will be able to forecast a better working capital requirement, a better income requirement in comparison to others, because they know that the specific genre of models have sold well in the market. Now, income we generate our trend analysis on the basic forecasting activity. So the previous 2 or 3 years income has risen 10% to 12%, say 15% on an average, 10% on from, say, year 3 to year 4, and then say 12% from year 4 to year 3 to year 2, and then from year 2 to year 1, we have, say, 15%. So we can take an average of, say, 13 to 14% for the current year. Now, depending on the previous increase of the previous trends. Now, small business new product last year started averaging 5% each month. Now, if, say, the product, as you are seeing this example, if a business sees that the product of particular product demand increases every year by 5%, then the managers might continue to say for last two, say 3 or 4 months, the demand is increasing by 5%. Then the managers will forecast that the sales of that particular product will continue to increase by this amount based on this steady upward trend. Now, project income forecasting, we have break-even analysis. Now, from the break-even analysis, this is a project forecasting tool. A break-even analysis is a project forecasting tool that calculates the um, number of units a product that must be sold, and a break-even analysis is a project forecasting tool. Now, this forecasting tool calculates the number of units of a product that must be sold in order to cover all the costs of a project. Now, if a project cannot company cannot sell enough of the project to reach a break-even point, a project is not profitable. Now, what do we mean by break-even point? The break-even point is where the company actually does not incur any profit, but it covers all its variable costs and its fixed cost in producing a certain product. So, if the lower the break-even point, the quicker is for that company to recover the initial cost, and attain a zero level position from where onwards. If it produces more, it will earn profit. So break-even analysis actually gives us the amount or number of units or the amount which the company will break even. That is, it will be in a no profit, no loss situation. Now, the break-even analysis helps managers to decide whether any project is financially viable, because and what prices to charge in order to make a profit. Because say if the break-even point is low, and the profitability is high, then the managers can go in for that. But if the break-even point is very high and the profitability is low, then the project managers may not be interested in such a project. This financial tools helps us to determine and at what stage the company or a new service or a product will be profitable. In other words, financial calculation determine the number of production the company should sell to recover its cost, basically the fixed costs and the amount of variable costs expended on making that particular product, the total cost that will be recoverable. Now, if say the number of units is lower for a certain product, then the project manager, if he has a choice, he will go in for that kind of a product more in comparison to a product which has a higher break-even point. Now, in cost benefit analysis, we have the cost benefit analysis is a project planning method which involves making lists of the costs and benefits related to a certain project. Now, in attributing values to those costs and benefits and then comparing the total expected cost with the other projects. Now we do the cost benefit analysis, means we do how much benefits means financial benefits or income are we getting back from that project, and from that we are deducting how much costs are we incurring on that project. Now this will give us the profit, the cost benefit analysis, which we compare the this with various projects and we choose the one with the best or the highest amount. Now based on the highest amount. Now project income forecasting. Now there are certain problems with income forecasting. Income forecasting, it relies on assumptions. Now this is a very bad point on income forecasting, because we rely totally on assumptions, because we feel that the previous year's trend will continue to the current year, or the previous year's demand will continue in the current year, and we ignore quality assumptions. We also ignore quality assumptions, means so the quality of the good produced in the previous year will be same or better than the quality of the goods produced this year. Now, bad math means sometimes there can be arithmetical, just numerical wrong calculations. A wrong calculation in a single place will totally destroy every prediction method, because you will be making, say, 10,000 units is the required demand in the market, but by some mistake somebody writes 11,000 units, then that 1,000 units we will be making wrong assumption on the basis of that. That is bad math. Failing to adapt, so there may be certain sudden changes in the market. The company process must be able to incorporate those changes in the market. If the company can, then it will survive. If the company cannot, then it will not survive. Now, by failing to adapt to certain changes in the market situations which could have been foreseen but which was ignored, it doesn't include such situations which could never have been foreseen. Now, being too conservative means if the company is not willing to take too much any risks. If you are entering into a new project, if you are entering into some new territory, you must not be too conservative in your approach. You must take some risks, because if you don't take any risks, then you are not going to make profit. Now, estimation of investment and a return on investment. Now, ROI, the return on investment, is an indicator that we use to measure the financial gain or loss of a project in relation to its cost. Now, return on investment means the return or the profit divided by the total amount of investment, and typically it is used in determining whether a project will receive a positive feedback and have value for the business. If the ROI is good, if the ROI is high, then and only then will the stakeholders go in for that particular project. Now, Otherwise, if that amount is low, and then the stakeholders might not be interested in going for that particular project. This is all for today. We'll continue with this in our next session.